Welcome to our Square Deal series, where we discuss commercial lending with interesting people. My name is Valerie. I'm the principal at Diamond Carré Capital Group, the place where you come learn, where funding and ideas meet. Today, I'm thrilled to welcome Shewchuk from Raimondo Petit. George, let's dive right in and kickstart the webinar here. What do you see for opportunities in 2023?
All right. With the current economy and the way things are going, there are a number of opportunities to acquire companies. We have generally the aging population of business owners. That's usually what's going on. And they're getting anxious to potentially get out of their business because they've held off for a while. Additionally, with the economy going on, we now have some struggling companies. So there's some opportunities to get some of those companies or their assets on the cheap. And also it's a matter of being in the right place at the right time.
George, how should company get ready for acquisition? And also very important, how do they minimize the anxiety?
That's a great question. A lot of people get flustered with trying to determine, what kind of company they're trying to acquire. And it kind of all comes back to that a lot of people miss is doing their own business assessment. Where are they? What are their gaps? What are their vulnerabilities? And looking at, how can they grow and prosper? And of course, how do you do that? Well, you look at other business advisors such as myself, and we get into a number of different analysis. One of the things we talk about is the SWOT analysis, which is strengths, weaknesses, opportunities, threats, and trends. Now we add that T, the trends, in for the accounting records. So what's going on in that business? What are their trends and how is that going to represent themselves? Another place that we look at analysis is called GPC. It's goals, plans, and challenges. So again, hopefully the company is doing a forecast, a 5-year forecast, a 3-year forecast. And if they don't, then they get us involved and help them formulate that. And then finally, which these business owners should be using, is called KPI, which is key performance indicators. And that helps them determine how their company is doing on a regular basis. So if they don't have those established, what works for them, then we as an advisor can help them determine those. And why is that important? So you want to know where you are and how a company that you acquire will help you. And whether that's market share, so that's called an industry acquisition, maybe it's a strategic acquisition, and you're looking at synergies between your company and the future company. There are other types of acquisitions, both a financial and an individual, but really as a company, what we're looking for is that market share or those synergies.
So George, after determining what a business owner is looking for, what are the concrete next steps?
All right. Well, as a company is trying to get ready to acquire, they've determined who they're going to go after. They need to get their financial statements and their tax returns in order to be able to be in a position to acquire a company. They also should have an advisor team in place. And that advisor team will help them understand what the other side is maybe trying to accomplish. And so we're able to, look at different ways to approach the acquisition to make all parties agreeable to the deal. It takes two people to work through this deal, and we want to make sure it works in our favor. So one of the recent companies I was working with was a printing company. They wanted additional revenue and capacity. They were looking at the location of this company and the equipment they had, but then they needed to figure out funding and then the timing of it. So we helped them get their balance sheet in order. They were able to accumulate some cash, and we were able to strike a deal with a note to the seller that they were agreeable, that we did an asset purchase, that ultimately we were able to time it that we were able to accelerate the depreciation, take a wonderful deduction, which was able to save the buyer some tax cash to be able to make the deal happen. And so, again, it comes to that planning with all of these aspects to be able to make the deal happen.
When we had a business broker back in April, he mentioned that 80% of deals end up not closing because, again, they don't have a team. They think they can do it themselves. They're emotionally too attached, to the
That's
business.
what it is. Yeah.
They don't listen, to the experts. I mean, I was blown away when he mentioned, like, I don't know if that's an accurate number that you will agree with. He said over 80%. Is that something outrageous, or would that be accurate?
I would say that a lot of sellers don't bring it to the table because they're too attached, right?
George, thank you so much for bringing a very important element, the emotional attachment.
Yeah.
These companies are closely held companies, and these business owners, these are the babies, basically.
Right.
And it's really hard to basically give it up and have a whole bunch of advisors, as great as they can be and as amazing how they can help them move forward in the process, and just hand it over.
And you're not necessarily just handing it over, you're working in tandem with these advisors. So that's what's important, is that we're not trying to control the transaction. We're trying to be helpful to the situation and work with you, the business owner, to help get the deal done for you to have the best advantage going forward and not have to pay too much for the deal. And so, hopefully we can take some of that emotion out of it, but we're still working in tandem with you.
Absolutely. George, you mentioned advisors. Would you share with us a little bit about what kind of advisors you were referring to?
Of course, that you need a full team of advisors, and it's not just your general counsel attorney. You should be looking at a mergers and acquisition attorney. Depending on the type of acquisition you're looking at, you may need to get a environmental attorney involved, a patent attorney involved. Depending on your pension and profit sharing plan, you may need an ERISA attorney that deals with those types of plans, being able to integrate those types of programs within your firm. Okay. And of course, you want to look at a business broker because they're going to have access to the type of business that you're looking for. So those business brokers help you with the negotiation on that price, but they also help you find those companies so you're not having to do that. The business broker is also a great asset, that they're able to do things on the down low, basically anonymously, maybe reaching out to one of your competitors, reaching out to your vendor, or reaching out to one of your customers, looking at that vertical integration if that's what you're looking for. So that business broker is a great tool. Just like the attorneys, you need that mergers and acquisition attorney who's able to deal with those agreements, which are a lot different than your general contract that you're dealing with on a general basis. As you're getting through and you've found that company, you also need some due diligence reviewers. So whether it's a company like mine or another accounting firm that will look at that company you're going to acquire, looking at their financials and trying to figure out, okay, do those financials actually represent what that company is, to make sure that we're getting the right deal. Along those lines, you're going to need an integration specialist to make sure that the processes are going to work. I have an example of, Morgan Stanley, when they merged with another company, making sure the computer systems work together. Okay. Then we start looking at the financial advisors. We talked about the tax, we talked about the financials, but the tax, what is the net tax cash flow that this is going to cost us? Being able to take advantage of that accelerated depreciation we talked to. But then finally, another thing that we need to talk to about is making sure we've got a great relationship with the lender. And hopefully, we're going to need to get those funds, and they're going to have to work with that balance sheet and P&L. And, we have to have a good relationship. And so we look at you, Valerie. How do you want to get that relationship with that company?
Absolutely. What a great point. Yes, indeed. I agree with the advisors that you just mentioned. And one key component of mergers and acquisition, it's capital. Most companies are looking at a lender or looking at a bank to get that acquisition. So we'll be looking at debt ratio, of course. Can this company afford, what they're looking for? We're going to be looking at collateral. We're going to be looking at the experience. You mentioned, business broker going out and looking at different companies. What kind of experience does the current business owner acquiring the sought after company has in that field? So there's multiples here that the bank is looking at. Obviously, we talked about financials. They have to be squeaky clean, because some of the problems that we run into are the financials that are not quite prepared.
And so do you work with those companies a little bit on getting their financials and tax returns in a right environment for you?
Absolutely. One of the key components that you mentioned, it's having a team, right? We're not just here to, hey, here's, let's look at your financials and then see what we can get from the bank. It's really being proactive and bring on board people like you. You have such a great experience as far as this tax CPA, and looking at every single line on the balance sheet and making sure that they work in order for the bank, for instance, to be able to help your client making that deal happen. Do that. George, in your experience, what are the main reasons why a mergers and acquisition deal will fall apart?
Well, thanks for bringing that up. And I think it goes back to making sure you've got an advisor team. Those advisors have the experience and the knowledge as to what issues will happen in these deals. There's so many things that are going on with that seller, with the buyer, that could kill a deal.
Yeah.
Okay? Ultimately that seller wants to increase as much net after tax cash, which sometimes they don't realize how much they're going to have afterwards until they start talking with their accountant, and the accountant's telling them, hey, you're going to have this much ordinary tax and this much capital gains tax. And so it's a matter of us specialists, we've seen it, and we can rework the deal somehow to be able to keep that seller in the realm of this transaction. It's a very emotional state for both parties. And, somebody trying to do it on their own, they just don't know what questions to ask or understand the other side, right? So we've got to be asking those questions to help that seller give up his company, his baby, so that way we can do something with it going forward and make our business that much better. So, we specialists, we've been doing it. We know the questions to ask. We know that when we get into an issue, there's a way to resolve it, where if you try to do this on your own, you haven't had that experience before. So use your advisors. That's why you go to a mechanic to, maybe do that oil change or get into the timing on these new cars that are so electronic. There's so much going on in these deals and these transactions these days that you need this team of experts to help you out. So what's changing and why? And again, hopefully having a clean financial that agrees to those underlying third-party statements.
Absolutely. We love nice and clean. and the story behind every line item, as you mentioned. George, I've heard the term clean financials used by different experts. So how do you use that term in this case?
So ultimately, one of the things we look at is when we're trying to prepare a tax return, we've got to be able to reconcile our retained earnings to prior year. What happens a lot of times is that clients will do something with their cash balances. And so ultimately, we need to be able to make sure that the cash balance on your financial report agrees to a bank reconciliation. And that bank reconciliation doesn't have outstanding checks over 3 years. Okay. So there's a lot of little things that kind of go into making sure that that balance sheet, that each of those line items, that there's some report that backs up that number. So looking at fixed assets, that maybe you don't have assets that have been on there for 50 years, that they look at cleaning those up on a regular basis and get rid of assets they no longer have or they're not able to use anymore. Making sure that the inventory agrees to some inventory, that they've done a physical inventory on a regular basis. That if they've got a credit card balance on the financial statement, that they're able to reconcile to a year-end statement, which sometimes I find that a lot of companies don't do that. They just record their activity and they don't go back and reconcile that ending balance on that financial report to those third-party statements. And so those kind of things are critical. And then, being able to understand, is there a debt to the shareholder? And are we able to recognize what that is? We have a note payable to a bank. Does it reconcile to a statement or an amortization schedule? So just trying to get that balance sheet in order, having it nice and clean that can reconcile to statements, okay? That we don't finally, looking at the profit and loss statement, that hopefully there's consistency between the years, that we don't have a huge expense item this one year that kind of sticks out as a sore thumb.
Clean financials are great, but we also have other components that are as important. For instance, the bank may require a phase 1 environmental. You also have UCC filing reports that are going to run, meaning that are you owing money to another bank or another financial institution? They will request AR or AP reports, inventory. If you have real estate as a collateral, they will want to run a clean title. They want to make sure that you don't owe any taxes or there's anything funny on your title. So there's a lot more other components that makes the deal go either smoothly or not as smoothly. George, thank you so much for taking the time out of your busy schedule and sharing with us the different but crucial steps in acquiring a company. Now, I would like to ask you if you do have final thoughts.
Valerie, thank you. It's great talking with you today. It is a wonderful opportunity to hopefully help your followers understand the opportunities that are coming up this next year or two, and being able to take advantage of these opportunities, because ultimately fundamentally luck and the IRS look favorably on the prepared. Therefore, your team of advisors is so important to get the right deal done. And if you don't have a team, or you need to fill it out with a couple extra players, reach out to Valerie and I, and we'll help complete that team for you. We have a bunch of resources in our back pocket. We want to help you get that deal done and make your company the best it can be for the future. Thank you.
There you have it, folks. George was kind enough to stop by today to share his expertise and very important steps in acquiring or selling a company. I want to thank you for your time today, and I hope to see you next time on our Square Deal series. Have a good day.